Hello everybody, and welcome back to another episode of Options Discovery on John Lothian News' The Spread. My name is Alex Teng, and I will be your host throughout this episode, and just like many of you, I am no expert in the options industry, but with a little bit of research and a lot of help from our special guest today, we're going to learn a lot more about options. And today's topic is going to be about risk and what it means to the options industry. Stay tuned to the end of the video because I get to sit down with Box Exchange CEO Tony McCormick to go over what risk means to the options industry and to give a little bit of perspective from his personal career path. Tony is an industry veteran, so it's an interview that you're not going to want to miss. Like I said before, today's topic is going to be all about risk and what it means to the options industry. Now, in order to understand what it means in the world of options, let's just talk about risk in general. Risk is all around us. It's a day-to-day experience. In fact, all risk is the likelihood that we'll experience certain consequences from our decisions. The decision to go to a crowded football game could increase your risk of getting a cold. The decision to go and gamble a bunch of money at a casino could increase your risk of you losing your money. When working with options, it's especially important to define what level of risk is acceptable to take on. And this measurement of risk acceptability is known as risk tolerance. Options are a tool often used for two different reasons. The first reason is that a trader wants to make a speculative bet on the price of an underlying asset. An example of this is if you think that a stock is going to go up in price, you can buy a call option on that stock, and if you're right, you could make money. When it comes to traders using options for speculative purposes, the question always comes to mind, why use an option? Why not just buy the underlying asset, or in this case, the stock? Well, the answer to that question is that options create something called leverage, which basically means you can multiply the power of your capital. See, no options contract is really written for a single quantity of an underlying asset. Every options contract has a quantity which determines the size of a single options contract, or how many assets are being traded underneath one options contract. The standard options contract size for equities, aka stocks, is 100 shares of stock underneath one options contract. So by paying a relatively small premium, you can leverage a much larger value of stock. This way, you can multiply the power of your capital, which basically means that you can earn more from the underlying price movements than if you held actual shares of stock. If a trader has a strong conviction on the price movement of an underlying asset, they will often buy options on that asset rather than buying the underlying asset itself to leverage their returns. Another reason why investors use options is to manage or hedge risk that they've taken on in other areas of their portfolio. In fact, hedging risk using options is a common practice among many traders. An example of this would be using an option strategy, like a collar, to manage risk in an underlying asset. Collars and other option strategies are often employed to mitigate risk, but these topics are a little bit more complex and we'll go over them in a later video. And although hedging risk sounds like some complicated Wall Street finance topic, it's really something that you personally probably do every single day. In fact, hedging is just a way to mitigate the consequences of a negative outcome. One of the most common everyday hedging scenarios that most people face is the decision to buy insurance. Whether it's your health, your phone, or even your car, having insurance can help mitigate the consequences of a negative outcome. So every decision that a trader, or firm for that matter, makes is really based off of their risk tolerance. Common questions that traders and firms both ask themselves is, what is our target return and how much risk are we willing to take? Therefore, risk is probably one of the most important concepts to know and study within the options industry. Luckily for us, I got to sit down with the CEO of Box Exchange, which is the regulatory arm for Box Options. So take a look at my video interview with Tony McCormick. So today we have a really special interview. Tony, can you please introduce yourself and what your role is?
Yes, sure, Alex. So as you said, my name is Tony McCormick. I've been in the financial industry, derivatives industry, since about 1975. I started trading call options for a bank back in 75. It was LaSalle Bank at the time. Then I went to the Mercantile Exchange, subsequently the Board of Trade, and then the CBOE. Right now, I'm the CEO of Box Options Exchange. We're one of 6 probably exchanges that still exist, listed option trading. We have about 8% of the market, so not an insignificant share. We're privately held. I run all the regulatory service for the exchange.
Yeah. So one thing that I saw was interesting was that you're at Box Exchange, which is almost the self-regulatory arm of Box Options. Is that correct?
Correct.
Okay.
We have the licenses and we're responsible for regulating the facility, which we call Box Options Market. I used to be CEO of Box Options Market also, but I migrated to the exchange side in 2014.
So when it comes to our topic for this week, we're
Right.
mainly diving into how options are used. So one of the biggest components of options is for managing risk. And so I wanted to just see from your perspective, being a veteran in the industry, how do you define risk?
Well, there's a number of different ways to define risk, but usually what you're trying to do is mitigate against some adverse condition against a position that you hold. So that's the risk side that you're trying to offload. And it can be different kind of risk for commercial interest as it would be for a general stockholder who wants to sell calls against a covered position. In other words, he wants to own the stock. He wants to take a little bit of the risk away. So what does he do? He sells a slightly out of the money or slightly in the money covered call, 1-for-1. And then the premium sort of offsets the potential for the stock to decline. And if he sells out of the money calls, the stock can appreciate up to that strike price, and he could collect the premium on top of that. So it's sort of a portfolio enhancement in that particular position. Commercial interests don't use listed options in the U.S. markets very much because the nominal size of the contract is too small. It's a 100-share contract, is a one lot. When you're trading portfolio money, like big institutions are that manage portfolio risk, pensions, profit sharing accounts, the incremental size of those positions is millions of shares. So you can imagine if you do the math, how many contracts you'd have to use to actually use that as a risk tool. So what they might do is they might go to an over-the-counter dealer like a Goldman Sachs or somebody of that nature or Bank of America or any number of big dealers that could help them if they had a concentrated risk that they wanted to mitigate. So what they would do is do an over-the-counter trade in options, and it would be tailored to what their specific need was. And then the over-the-counter desk might, and that's where I say might, use one of these trading floors where I talk to you about these block trades going up sometimes. They might offset some of that in the public market and try to piecemeal off some of their risk rather than holding the entire risk themselves. But generally speaking, it's the retail trade that trades listed options in the United States.
Got it. So when it comes to hedging bigger portfolio risk, like you said, for big pension funds, a lot of it's done over the counter, which to my understanding is more custom contracts that you can do with an over-the-counter dealer.
It's totally tailored. They can pick a specific date, an exact amount, all those things. Whereas the other standardized contracts, the dates are preset, the strikes are preset. As I said, the notional value is very small.
To wrap up this interview, I want to start asking guests the same few questions. The first one is, while working in the options industry, what are some of the most important lessons that you've learned?
Well, I think the most important lesson is to understand what you're getting into, especially for a new trader. So if you're just getting into it, dip your toe into it, start small, start maybe with a one lot even. Basically, I would say don't take a short side of the position in anything until you really understand it, because that's where the risk can get a lot bigger and a lot more. It could almost be unlimited in some cases. Even with a small amount, you could lose a lot of money. If you're long premium, the worst thing that can happen to you is you're going to lose your premium. And quite frankly, most option traders are long premium position traders, and they do lose their premium. Whereas conversely, the short side of it, what I'd call more the professional side of the trade, it's a higher probability of making money. So if I were to get into it, I'd find a stock I like, I would buy the stock, and then I would look to cover the stock position with a call position. So I either pick an at the money call. I don't know if I can do an in the money call because otherwise, why do you own the stock if you want to protect yourself in the money? If you want to be delta neutral in the money, why be in the stock? But be in the stock, sell an out of the money call 3 or 6 months out, watch how it acts, and hopefully it'll go up a little bit in your stock, and the premium will go down along the way, and you'll end up being able to roll forward and do it again. And you'll keep owning the stock, collect the dividend, but also the premium on the call position. So that's a nice covered right position. It's very safe. It's a good way to learn about options. There are a lot of strategies you can do. I could talk to you for an hour about different strategies that involve spreads and different, bulk verticals and all kinds of things like that. Iron condors, butterflies, and there are books that you can read about those things. I would say for the average investor, that's not something you should jump right into. There are a lot of professionals that do that kind of trading. It requires capital. It requires almost constant management of the position. You've got to have a real-time feed of quotes to know what's going on. But if you want to just get into it slowly and carefully, and you can learn, there's tons of great books on options to learn from.
Great. I think the viewers will really appreciate that. And that's definitely, a great strategy to start out with. Every week we choose a new topic for the show. Like I said before, this week's topic was risk. What is the topic that you would recommend we dive into for next week's episode?
Well, I think you could start migrating up that food chain. Maybe next week you start with that strategy I just identified. Just basically break down for somebody what's a covered writing strategy. How does that work? What do you look for? How do you manage it? And then the next one could be a spread strategy. You could do the next safest thing is probably to do a collar, and a collar basically is I'm long the position of the stock. I sell an out of the money call. I buy an out of the money put. So I've collared the position. If it goes down, my put that I'm long will protect me on the downside. If it goes up, my stock might get called away, but I've sold that call for a premium at a higher price than the stock already is. So that's both sides of that. Cover your position.
That's a great topic to dive into for next week's episode.
Well, good luck. I think it's a great program and a great idea, and I'm sure people will learn a lot from it.
Well, thank you, Tony, so much. I appreciate you taking the time for this interview, and hopefully we can talk to you again sometime in the future.
Sure. Pleasure talking with you. Good luck. Take care.
Thank you. All right, everybody. I hope you enjoyed this video and learned a little bit more about risk in the options industry. Now we can keep this knowledge and move forward as we go through more complex topics in the world of options. All right, everybody. Thank you for watching, and I'll see you in the next one. Bye. If you're hungry for more options content and you just can't wait, feel free to subscribe to the John Lothian News YouTube channel, as well as all affiliated social media accounts. Also, be sure to check out johnlothiannews.com, Markets Wiki, and the John Lothian News newsletter.